This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is see you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to creators
Mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Altco's Mainstream podcast. Today's episode is with a private equity pioneer who has seen the industry evolve in the 40-plus years he spent in private markets. We sat down with Steve Klinsky, the founder of New Mountain Capital, which he started in 1999 and has grown to over $55 billion of AUM with an investment platform that spans strategies across private equity, credit, and net lease real estate. Steve was the co-founder of the Leverage Buyout Group at Goldman Sachs from 1981 to 1984, where he helped execute over $3 billion of transactions for Goldman and its clients. He then joined Forstmann Little and Co. as an associate partner and then a general partner, helping to oversee 7 private equity and debt partnerships totaling over $10 billion in capital. He's since built New Mountain Capital into a leading alternative asset manager that has charted a growth path. Yet the firm has remained true to its roots and mindset of its family business background, which has informed how New Mountain has partnered with both GPs and LPs, and in particular, central to their recent rollout of a wealth solutions business. Steve and I had a fascinating discussion about the evolution of private markets and how to build a leading alternative asset manager. We covered how private markets have changed since Steve began in the industry, what it means to build great businesses, how the mindset of the family business background has helped inform investment strategy and deepening LP relationships, how Steve and New Mountain have navigated scaling the firm while focusing on generating returns for LPs, how New Mountain has approached launching new strategies, why New Mountain sold a GP stake to Blackstone Strategic Partners in 2018, and the why and the how behind launching a wealth solutions business. Thanks, Steve, for coming on the show to share your wisdom and expertise on private markets.
We're going mainstream.
Steve, welcome to the Altco's Mainstream podcast.
Thank you. Thanks for having me.
Pleasure to have you on. You've had such a fascinating career in private markets. You were there in the very early days. So let's start there and then we'll get to what's going on today. But
Great.
I'd love to hear your background and what it was like in private equity when you started.
Well, I'm one of the longest standing people you're going to find in private equity. I came to New York in 1981 as buyouts were just beginning. I was co-founder of Goldman's original private equity group. And we can talk about those days, but it was a very, very different world in private equity than it is today.
What was it like then?
The first leverage buyout of a public company was in 1979 when I was in graduate school. KKR bought a company called Hudai. And I was like the youngest person at business school and I had no work experience. So I said, hey, well, this is an interesting new idea. I wrote my graduate law and business thesis on what is a buyout and all that. When I went to Goldman Sachs in 1981, I said, I want to be your buyout guy. They said, we've never done a buyout. So it's like wanting to be the wheat farmer on the moon. There was no competition for the job. I was in their merger department and we set up a buyout group and I worked on Goldman's first ever proprietary transaction. It was a $12 million paper bag company This firm was the size of a law firm back then. We could all fit in one room for the Christmas photo at Goldman Sachs. And it was a $500,000 investment from the firm. And I think the two CEOs of the firm were watching over my shoulders, the heads of investment banking. So it was just a different world. The other important thing is you had stagflation from 1968 until about 1981. So the stock market was lower in 1981 than it had been in 1968. It had been a kind of a lost 13 years, and everything was, interest rates were 15.84%, the 10-year treasury, highest interest rates in history, were the day before I started work. So it was just the takeoff of this whole giant last 40 years.
So just to kind of put numbers behind things, just to kind of help show people what the size and scale of private equity was then and what it is today. You mentioned KKR, 400 million of AUM at the time, 20 private equity firms. What was the size of the investable universe then?
I've also been the chair of the private equity industry in America. It's gone from 20 firms to about 5,000 firms. It's gone from maybe $1 billion of capital to about $5 trillion of capital. So the only thing that's maybe grown faster than semiconductors or something is private equity. It's been an amazing field. And the investable universe, the stock market was so much smaller. A buyout price for a company would be like 10 times net income with no adjustments. That would be an acquisition premium to get up to 10 times. I mean, things were really beaten down because the interest rates were the highest in history. The market was very low. So it was just there was a value buyer's time back then. So the whole idea was, who would lend you money to buy a company? I remember helping Taft Theme Parks, which owned Kings Island and stuff, do a leverage spin-off of their company. And so who's going to lend against a roller coaster? I mean, what good is that as collateral? You say, no, it's a great steady business.
You were at Forstmann Little.
Yeah.
And then you decided to start New Mountain Capital.
Yeah.
Talk to us about that.
Yeah. Well, I had a great period at Forstmann Little. So I was there from 84 to 99. We were the second biggest firm in the world. This was the glory days of Forstmann Little. It was a very small, glamorous firm. I was essentially the senior guy outside the Forstmann brothers. Ted was dating Lady Di. We owned Gulfstream Jet. We had more people flying the jets and the helicopters than working at the firm. It was just a very glamorous, Great Gatsby type period. And our performance was great in the years when I was there. I did investments like General Instrument that went from $1 billion of value to $20 billion and started the whole cable revolution and video on demand revolution. But it was kind of a dysfunctional place culturally, and I broke off and started at January 2000 as official first day of New Mountain.
You touched on something that I think is so important when it comes to understanding these firms, and probably even more important today as these firms grow in size and scale and the different things they do, but culture.
Yeah.
What were some of the biggest things you learned from being at different firms and thinking about culture, and what about culture is so important when it relates to building a private equity firm?
It's extremely important. New Mountain is based on two investment ideas and one cultural idea. So we'll come to the investment ideas later, but it's defensive growth, business building are the big investment ideas. The cultural idea is to be as flat, non-political, intellectually honest as possible, very respectful. One thing that's important in my background is I grew up in a family business in Michigan. So my grandfather and grandmother had a store that sold coats for 30 years. My dad and uncle built it into a chain of stores. And a lot of people in my firm come from small family businesses. So we say we don't have portfolio theory, we have family business theory. When we invest in a company in private equity, we treat it like the new family business. I'm proud to say we've never had a bankruptcy. We've never missed an interest payment in the history of our private equity effort, and have had $87 billion of enterprise value gains. And so that kind of respectful idea also applies to how we treat people. We include every associate in the investment committee meetings. Everyone in the firm gets carry in every deal from the receptionist on up. And so we just try to get the best people working together.
How do you think that culture manifests itself when it comes to working with entrepreneurs and management teams?
In private equity, 85% of the time when we buy a company, the seller is keeping some stock in the deal along with us. And our pitch is, we don't just, we've never bid just in blind auctions. We say to you, if it was your family business, look, let's come up with what you consider to be a fair price. If we can meet it, you would want to do the transaction with New Mountain because we have a plan to actually grow your business. We're not going to bankrupt it. We're going to keep it safe and preserve it. But also what's really important is the business building. We've been able to build major companies. And that's why we have a 250 person team, because it's so operational. And it's not, hey, we're going to do 4 deals. 1 will make 20 times our money. 3 will go bankrupt and we'll buy a car. That's not the way we think about things. And so that affects the sellers choosing us.
I think you bring up a really important point, which is the way in which you think about your firm and the firms that you're working with manifests itself in the investment process. How do you maintain that same ethos as you scale your own business?
When I left Forstmann Little, there's only 8 people at the firm, including the 2 founders, myself, and some younger people, despite how much capital we had. So I went off on my own. I started in a rent office with a metal desk for New Mountain about 25 years ago. So we've gone from 0 to 55 billion of assets. But the way you scale it is, it's just consistent principles. It's treating everybody as a part of it. The same ideas we use for private equity. If you have never had a bankruptcy or missing interest in private equity, you can drop down to the credit level and under 40% loan to value and be even safer. So we have a very, very strong credit operation. We do the same thing in net lease, which is like credit, but you're collateralized by the building. And it's, and we're incredibly careful on our hiring. I and the other senior people meet every associate before we hire them. We're all on effectively 1 floor, spread around together, feet from each other. We bring in lunch 4 days a week and line up with the administrative assistants and get our lunch. I mean, it's that sort of a culture.
That kind of sounds like a family business in a sense.
Hopefully in the good sense. I come from a family business, so I don't want to, there's good and bad. Family business get very complicated if you have this cousin and that cousin and stuff. So it's very merit-based, but it is respectful the way a family business should be respectful. I've written an article in Harvard Business Review a year or so ago that people could just download. And we used a case study of a business called Blue Yonder, where we grew from 600 million to over 8 billion. And what I try to explain is it's not about using debt in private equity. You get the combination of being like a family business where the private equity firm owns the shares, knows everything going on at the company, but the scale and merit-based of a large organization. So you try to get the best of family business plus major scale merit-based.
Do you think that's gotten harder in this industry as firms have scaled and maybe even in some senses gone public? There's positives and negatives to going public, both for the firm and for the investors. But has the industry changed in that regard as growth and scale have come to private markets?
The industry itself, I think, is just exceptionally better today, which is, it's now been 43, 44 years I've been doing this. And I'd say it's gone from a form of finance into a form of business. A good private equity firm, and we're not the only one, really thinks of themselves as business builders, has strategic advantages in key industries, deep knowledge. So that I think is very positive. I personally am very happy that New Mountain is not public, because the problem with being public is that you're very focused on just asset accumulation, because the stockholders are saying, well, what's your fundraising plan for first quarter of 2028? We don't think that way. We just think about how can we be best in class at everything we do. And we are growing in assets and we want to grow in assets, but it's more organically by where is the opportunity. And, instead of having a fundraising target, we have a performance target.
Well, what's interesting, I think, and this relates to your most recent fundraise, you met and exceeded your hard cap. I think you raised over 15.4 billion or so. And you were expecting to raise 12 billion.
Yeah.
I want to unpack that, because I think that's such an important aspect of, particularly from an LP perspective. They look at a fund size and say, usually your fund size is your strategy. And they look at that and say, okay, how can I generate similar returns even if the fund size gets bigger?
Yeah. Well, first of all, I think you can make money if you're good at any size range. So I've worked on everything from the RGR Nabisco deal in 1988, when it was the 19th largest company in the world, I think, to my cousin's auto parts store, where I helped him get it private for $2 million. So, you can do things. New Mountain itself focuses on what are called mid-market companies, 500 million or 600 million average enterprise type businesses. We do have mega fund strength to buy mid-market size companies, and the fund size has gotten bigger over time. But what's key is not the fund size. What's key is the fund size relative to the talent within the fund. So I talk about a talent per dollar ratio. We have more team leaders than ever on a project, more operating partners, more skill per any dollar that we invest than we ever had. So our team is growing faster than the size of the fund. And if you took, any two $1 billion funds and combined the teams, they could easily invest $1.5 billion collectively. It'd be easier than investing $1 billion each. So you really have to look at the way that the team is built and managed under the fund size.
On that point, where do you think there's the most opportunity for value creation? Because you mentioned you also don't use a lot of leverage, which not every firm does that. But that's a big piece of why you've been successful is you're actually operating these businesses well.
We're allowed to invest at any size we want. We keep coming back like a magnet to an average size of about $500 or $600 million. The advantage of that is it's a lot easier to take a company from $500 million to $2 billion than it is to take it from $10 billion to $40 billion. There's many more companies to look at, many more buyers on the way out. And most importantly, at that sort of size, you could be a great niche leader. Someone may have built a wonderful business in an important niche, but may never have taken the company internationally, may not know how to add AI to their systems, may not have built the sales force, may not have done add-on acquisition. So we like that size because they're important companies, but there's lots of room to grow them. We occasionally do larger ones, like we had a lot of success in the accounting area with a firm called Cooperman that we've now sold. We were the first one to kind of pioneer accounting firms after 8 years of talking with Cooperman. We sold it in a very good exit, and now we own Grant Thornton, which is larger, but there's tremendous opportunities at Grant Thornton because we can buy up different countries. So we don't do it because it's larger, but we stay in that mid-market space and occasionally do the larger one if it's too good to say no to.
How has the growth in the industry within private equity and the AUM that's come into private markets, how has that impacted firms like you that are focused on the mid-market?
Well, it only makes it better because it gives you more exit options. So when we sell our companies, about 55% of the time we sell to strategics, about 40% of the time we sell to other private equity firms, or also the giant sovereign funds and the big Canadian plans like CPP and so forth are buyers themselves because they co-invest with the firms, or sometimes they buy them directly. So it just makes it a more liquid universe to sell companies to and so forth.
On that point, where my mind goes as well is the new product innovation in private markets, things like evergreen structures, continuation vehicles, the growth in the secondary space. All of those things seem to be, especially for a mid-market private equity firm, net positive from a liquidity perspective.
Yeah.
How do you think that is going to impact private markets going forward?
We're a multi-asset manager. We're in 4 spaces now. And I think the expansion, and we're also very involved with some of the ideas you just mentioned.
Mm-hmm.
I think it's all positive because the way we think about it is we have one central analytical engine, which is that we built for private equity. So let's say, and we've been very successful buying software companies, like I mentioned, Blue Yonder. Let's say a great firm like Vista buys a software company that we don't buy at 20 times EBITDA. We don't want to have to outbid them at 21 times, but for us to drop down and be their lender at 6 or 7 times, we feel very comfortable with. But what's great is the same team that would have bought the company for private equity, the same software experts, are the ones advising our credit portfolio managers that, yes, this is a good software company. Yes, we should lend to it. So you get to use your knowledge in multiple ways. The key is to really understand industries in a very, very deep way, choose the right industries to be in. And again, I talked briefly about defensive growth, but the idea is there are industries that are going to have the wind at their back for the next 5 or 10 years, whatever happens to the macro economy. And there are other industries that if they melt underneath you, there's nothing you can do about it. So we try to be in the best industries with very, very deep knowledge and the ability to improve companies. So you can own companies, you can buy convertible preferreds, you can make loans, you can lease them their building, but it all comes off of that same analytical engine.
How much synergy is there between the different businesses that you have and the different investment strategies? Are you often pairing some of those strategies together to help a company and finance a company's growth? So credit and equity, or?
Well, for example, we don't lend to our own companies because we don't want conflict. So we're not pairing in that way, but there's tremendous value in being able to have one team that can use its knowledge in any way that makes sense. So again, if there's a great life science supplies company, and we've been studying it for years, if we can acquire it, we would. If they don't want to sell it, but they say, give us some growth capital, we can do that. If they say we don't need capital, but we need a loan, we can do that. We can do a net lease. So the key is, I said, you use terrible analogies. So one of my bad analogies is like having a fishing boat where you go out to catch a marlin. And if you catch a 500-pound tuna, you don't have to throw it back anymore.
Yeah.
You now have a bucket for that. And so by having multiple asset classes, we have a larger team. We have now peripheral vision in all the different markets. And again, the way the culture of my firm works, everybody's included into the investment committee meetings. Everyone gets carrying the deal. The credit person might say, oh, I lent to a company like this 7 years ago. Stay away from it. This is a problem you all don't see. So you just get better knowledge as you get bigger, stronger.
Well, I think that's a great analogy, right? Because it's where you are today as a business, you're more of a solutions provider than you are as a private equity firm. And I think that's emblematic of where the industry has evolved. I want to touch on that point because you mentioned great growth industries earlier. You mentioned that private equity itself has been a great growth industry. And I think I'd be remiss if we didn't talk about the growth in asset management businesses. I want to talk about your own business. We talked about helping companies and helping them grow, but your own business has gone through tremendous growth. You took a GP stake from Blackstone Strategic Partners 2018. What was the thought process behind trying to grow your own business and financing that with outside capital?
We sold a small stake of the firm. We sold 8.7% to Blackstone Strategic Stake Fund. The important thing was we took all the money we got and we put it all back into the balance sheet of New Mountain. So nothing went out into people's accounts. It let us invest more than ever into our own products. Mm-hmm. And, it's been very positive. And the other thing is, unlike being public, there's no governance rights for the stakeholder. We don't tell them what we're looking at. We don't need their approval. We have to show them they're getting 8.7% of the right denominator every year, and they try to be as helpful as they can. But, you're still fully control your own shop and also get the ability to build your balance sheet.
What made you say we need to have a dedicated focus and effort on the wealth channel?
Well, it is a major channel, and we think there's a big opportunity. There's a few big brand names that went into the channel first that are well-known and great brand names. But, when people's eyes adjust and they go, well, I got the big brand name, but let me really who has the best performance, who has really something special. We think there's still room for a best-in-class player to join and still have an important position. So that's what we're working to do.
On that point, how do you think about building your brand so that the wealth channel, one, understands who you are, and two, you're able to educate the wealth channel, not just on the merits of private equity or credit or net lease, but your specific way or edge about going about investing in that space?
We're building our brand kind of in the old-fashioned way by trying to have good performance year after year after year for 25 years. And we do win awards for this or that.
You get on brackets.
Yeah, we're good. Yeah, yes, we got, we're in the Sweet 16 of private equity. Some group named us as the Cinderella 16th, So, which is nice out of 5,000 firms because we're not out, buying advertising and things like that or trying to get into those things. But, by really good performance. And also we've had a very consistent message in other ways. We've been talking about private equity as business building for 25 years. So we weren't the people saying, borrow as much as you can, debt creates returns, and switch. We've had the same message. We've had a social dashboard since 2008 where we track our social metrics. We've added or created over 70,000 jobs, net of any job losses, $8 billion of R&D, CapEx and software, never a bankruptcy, $87 billion of gains. So we've had a very consistent message, and we think it will resonate with just the wealth channel because it's business building, it's non-cyclical, it's common sense, it's not a trick, it's not exploitation, and we think we have a natural affinity.
One of my favorite questions to ask as an LP is really discerning what a firm's edge is. What would you say your edge is?
Well, our edge is a few things. It's the model is the most common sense model imaginable. Mystifies me why everybody doesn't have the exact same model. Other people don't. But what our edge is, number one, we've been able to walked the walk for 25 years, or I had a pretty good 44 years of walking the same walk. The industries that we are deep in, we are so deep. So if just for example, in healthcare tech, the biggest healthcare conference of the year is the JP Morgan conference every year out in San Francisco. My team has its own conference the weekend before in Napa Valley, where the CEOs of the major healthcare companies are coming with our portfolio companies, and because they're our clients, they may buy the companies one day. We're not just a little firm saying to the investment banker, "Oh, what are you selling this week?" And it's the same way in a number of other infrastructure services and other areas like that. Plus, you can just see the retention of our team, the operating quality of the team. Our loss rate has been exceptionally low compared to other firms. The returns have been very strong.
How do you make sure you get that message out? Because I think as you see this evolution in private markets and the growth of the wealth channel, the largest firms have the size and scale to invest in brand, boots on the ground, and marketing. And I think all those three things have to go together to be able to do it well and do it effectively. As a firm that's now just starting to go into the wealth channel, and $55 billion firm is by no means small, but it's not $1 trillion, and it doesn't have a 600-person team focused on this space. How do you think about building brand given your perch in the ecosystem?
I think it's actually kind of an advantage in some ways to be at the size we are, because we're big enough. We are one of the major firms in the world. I mean, we're big enough to be around and last. But for example, if we buy credit, as we do, we have a credit arm, we can be very bespoke. We don't have to buy every piece of debt that's on offer because we're not so big that we just have to get the money out. Yet we have the relationship strength and the relationship power of a major firm with less dollars to invest, so you can be very selective. And I also think if I'm I'm a wealth manager, you don't want to just buy, Ford Motor Company is the biggest auto, so you ought to buy a Ford, or you ought to buy that same Honda as everybody else. You're saying, well, look, okay, you got a Honda now you want to get kind of a special car with special features, and you can be a little more sophisticated in your choice. So everybody doesn't want to have to buy just the average brand. They want to get the special thing that they are selling only and they know specially.
I think that's a really interesting point, because it feels like we're at the point in the evolution of the wealth channel's adoption of private markets, while still early, but the larger firms in the independent wealth space and the private banks, you mentioned you're on some private bank platforms like Goldman and JP Morgan,
Yeah.
where access is now table stakes in private markets. The wealth channel can go on platforms like iCapital or Case and get access to many of the large funds. But now it's about customization and differentiation. So I think that's where we are, and there's platforms that are helping firms do that. But then the question is, how do you as a firm think about that and make sure that you are part of that trend of customization and differentiation, where maybe firms are going to buy the biggest brands, but they're also going to know to buy New Mountain as well?
That's exactly right. So ultimately, it will come back to our performance and what we have. And then to get the message out, obviously in the traditional institutional space, we had a $15.4 billion fundraising. We have we're well known in that world of major institutions. Going into more of the wealth space, we're not as well known. And so we've created a 9-person force. I think also, if a head of a RIA firm meets our people, I'd be happy to sit down with them for lunch. We're out. You can have a more one-on-one communication with us and go, all right, I get the New Mountain story. That's the one my 5 competitors don't offer New Mountain. They don't know them. I'm going to offer it. And it could be a little bit more special and selective.
What was the thought process around how you'll start to engage the wealth channel? You have different strategies. How have you gone about? I think it's always fascinating to hear how people built their business focused on the wealth channel, because it's so new, and it really is like building a new business within a bigger company. How have you thought about productization, and what product is the right fit first for the wealth channel? And then how do you go from there?
I'm honestly not sure what I'm allowed to say or not say, because I can't really talk about specific products. What I will say is we have products that already exist for the institutional channel. And so we're not trying to invent some new product. What we're saying is, if we have existing products, let's make them available for the wealth channel.
On that point as well, I want to touch on something more broad, which is The industry's evolving. You've been in this industry for a long time, for over 40, I think you said 44 years,
Yeah,
roughly
since
speaking.
81.
So Dave Layton from Partners Group, CEO there, said something interesting a few years ago, which was he thinks that the industry could go from 11,000 firms to 100 platforms. And now you obviously have the traditional asset managers. BlackRock has gotten into this space in a big way with HPS and GIP. Other asset managers have acquired firms and capabilities. So they're trying to get into the space in a deeper way as well. How do you think that this whole space unfolds?
I think in the wealth channel, there might be a fewer number of major players than in the institutional channel. In the institutional channel, if you're the endowment officer for a university, sometimes they like the small new specialist because they feel, it's more unique or they know it better. Wealth is a more complicated, you're covering an entire nation or entire world. It's harder to build a brand. So I think there might be a smaller number of major winners in the wealth channel. I think there'll always be lots of different asset managers and private equity firms, but it may I think it's already happening that the dollars are getting more concentrated in the larger firms, of which, we have been on that positive side of it.
On that point, do you worry about the institutional side of the business that, then this is a trend that's happened for the last 15 years, but the large pensions and endowments and sovereigns have found ways to co-invest more. They've concentrated and shrunk their relationships into less firms rather than more. Smaller endowments, I think you've seen shifts with their ability to hire more people. They may have to outsource that to OCIOs. So the industry on the institutional side is changing. What's your feeling on the institutional side of private markets and how they'll continue to participate?
Again, this is different from the wealth channel. Back on the institutional side, there are new institutions entering the space all the time. So, for example, like I say, my firm has grown out of concentric circles. Well, let's go way, way back. When I was at Forstmann Little, it was basically 10 corporate pension plans that don't even exist anymore because they all stopped their pension plans. They became defined benefit or defined contribution instead of defined benefit. When I was starting New Mountain, it was the big state funds. Then it's evolved and into Asia and other places. The sort of institutions that are coming to the market are family offices that are effectively institutions in themselves. Someone sells their tech business for X dollars and hires a team, and they want to be in the best new fund. So I'm not so worried about. I think anyone who is really good at adding value in business building, if I was this, starting New Mountain all over again, I think if my performance could be good, I could start it all over again today because it's based on what you can do as an investor. The wealth channel, I think, is more complicated because you have to cover a different sales force and do things differently. And I think the important thing in the wealth channel is not to kill it through mediocre performance, or I don't want to just have every investor get a telemarketing message, hey, XYZ fund will, like hearing from a shyster lawyer or something. I think there should be gatekeepers and careful people making sure it's the right fund for the person to put their money in.
Do you think you can provide the same product just for the wealth channel, maybe in a different wrapper, as you can for the institutional channel?
The way we think about it is it's the same investments we would have made for the institutions, but set up in a way that works for people in the wealth channel. And the difficulty, the barrier is you have to then have salespeople to go out and talk to the wealth channel and do all the work to set it up, which is why it's harder to enter. I could not have done this 25 years ago from a rent to office, when I was starting New Mountain. But so I think it will be a smaller universe of well-respected brands.
I think that's a really interesting point. I want to slightly shift gears, related question, because it's about how you think about investing. You've been in this industry for a long time. What has been the most painful investment you've ever made, and what did you learn from it?
I can always talk about the good investments. I'm happy to talk about the painful investments. The most painful investment was back in around 2007 or whatever. We bought a company that was growing very fast, had been Entrepreneur of the Year award, that sort of thing. And when we owned it, we found that the accounting was wrong inside of it. I'm not going to, throw criminality around because we're never formally prosecuted, but it was not what we believed it to be. It was the first investment in our third fund. And so it set that fund off to a terrible start. I had to go out in front of the LPs and said, look, it's I accept responsibility. If anything goes wrong at New Mountain, it's my responsibility. So that was very painful, but we did not throw the keys away. We doubled down our effort or tripled down our effort. The part that was defective, we never got our full money on back. But there was a little piece of the business that was making $1 million, a different little unit that was like off in the closet. And we grew that by 30 times in size and ended up making a gain on the whole deal. So it worked out, okay, but there was no fun. And so, and what you learn, and, we're in a continuous improvement mindset as a firm. So I think my team back then was 25 people, not 250 people, but the sort of extra people you add are better, we now don't buy a company unless it's been screened for all sorts of compliance checks that we didn't have in place back then, or we have specialists in other areas we just didn't have. So you try to get stronger and grow through it. But there's always going to be problems. The nice thing is if you're operational and you're not over leveraged, you have a chance to go fight to save the day.
On the flip side, what has been the best investment you've ever made in the context of great investment, but also learning the most from it?
The investment I care most about is I don't take credit for any individual investment at New Mountain. You'll never see my name other than the first deal we did 25 years ago because I had no one to delegate.
There was only you.
There was only me, effectively. But so you don't say, Steve did this deal or so. What I care most about is building New Mountain as an institution and the quality. For myself as a deal doer, back when I was at Forstmann Little, there was this business General Instrument that was the leading tech deal of the 90s that people thought Japan was going to take over the American electronics industry. And we came back with digital HD TV and we helped develop cable modems and stuff. So that was personally very satisfying. At New Mountain, we've had all sorts of great successes, companies like Signify and Equian and R1 and, lots of different, we have 87 billion of enterprise value gains, so it's been a bunch of good ones. What I really care is about the process to grow it.
Has there been a common thread with all of those successful investments? What would you say that common thread or those common threads were?
There absolutely is. It's the same story over and over and over again, and we try to execute it better as time goes on. And again, I'll refer your listeners to this article in Harvard Business Review, but we start with the industry identification. What industry should do well for the next 5 or 10 years, even if the macro economy goes bad? So we're not guessing on fashion trends or turns in the market. Then we take a business like that. We don't over-lever it. We use leverage, but we usually use about 4 times debt to EBITDA. And we build it. So again, a company like Blue Yonder that started as a little company called Red Prairie for $600 million, kind of a very boring software supply chain software company. And then over the years, we added AI, we added new management, we totally took it around the world and sold it for $8 billion. So there was no trick to it. There was no single magic change. It wasn't, but safe base, non-cyclical business building vision. And we've done that again and again.
You mentioned being able to leverage things like AI today.
Yeah.
And take a good business and make it better.
Yeah.
How much do you think digitization and AI will take businesses that had good EBITDA margins, maybe 30, 40%, and make them 50, 60%? Is that type of thing possible with AI?
What we've been doing for a long time now is taking a traditional services company and adding technology to it or kind of VC upside to stable businesses. So let me give the way AI was used in Blue Yonder was before ChatGPT. It was, and we named the company, it had been called Red Prairie originally. It got called Blue Yonder because we bought a German company with 72 PhDs called Blue Yonder and renamed the whole business after them. They were the little add-on. And the AI this was like 5 years ago, was if there's a storm in the South China Sea, how will that affect delivery dates to Bentonville, Arkansas, where you're using all sorts of big data patterns. But in general, you can add digital technology or other technology. So we had a company called Signify that we bought, I think for like $400 million debt free. It was sending doctors and nurses into the homes. And the thesis we had was if you could get into people's homes and keep them healthy, that was a very important non-cyclical trend. And there were no companies really doing that well. So we bought two little ones, put them together, renamed it Signify, put in a new strategy, put in a new management. One of the major things we did there was change the whole scheduling and logistics system. So a doctor used to get to 9 houses in a day, can now get to 10 houses in a day. That's like creating a 10th doctor out of thin air, totally lowers the cost structure, makes them the most efficient in the industry. We just gained share, and we sold it for, I think, over $3 billion to CVS. So, and AI is another version of that. It's just, and we're using that. It's a very important version where we think there can be tremendous efficiencies, but it's not like saying to ChatGPT, what is our business strategy? It's just step by step throughout a company. How do you run things better?
Well, you mentioned something like Grant Thornton, right?
Yeah.
I mean, the services business that if you can create synergies through tuck-ins, acquisitions, getting to scale, leveraging technology, AI, all of that to make the business even more efficient. It feels like a lot of these services businesses, there's tons of opportunity.
Well, that's exactly right. So, you take a business that's already safe and predictable, but if you can raise its margins, so that's exactly right. Like a Grant Thornton or with Citron Cooperman, which we just sold, they have thousands and thousands of clients. If you buy a little advisory specialty firm, you can now roll that across all of your clients. So that's very accretive. Grant Thornton, there's a Grant Thornton of every country. So we can go out and buy the Grant Thornton of other nations, put the group back together and do that very accretively, and also just make their systems more efficient.
When you think about value creation in private equity in particular, is there one lever that ends up being more effective than others? Is it, as you mentioned, is it acquisitions? Is it bringing in operating partners? Is there something that you've found across the deals that you've done that's created more value than other things?
There's a lot of important leverage. So getting the right management is very important. We work very closely with the management. Acquisitions are important. But we have a formal operations playbook now that has, like, I think 20 or 21 parts to it. Pricing, sales force construction, supply chain management, procurement. We've saved, over $150 million at our companies in the last 4 or 5 years through advanced procurement. Times 10, that's $1.5 billion of value in itself. So it is not like one trick again and again. It's a whole set of techniques that we try to make sure every company can be at their best.
What size and scale is a firm, New Mountain, were you able to really be able to implement some of those things? Like you need a team to be able to help with procurement, things like that. So when was that growth curve occurring within your firm to help with?
If this was an LP presentation, I would turn you to like chart 17.
Yeah.
And what you see is we have the growth of the team over time. And it starts with one, because I'm sitting in a rental office. And now it's up to, I think, 265. But what's interesting is it didn't happen in 1 year. It's been a smooth, continuous build. So, back in, 2005, I had 3 team leaders, no operating partners. Now I have 20 or 21 team leaders, but they all started as first day associates, and it's now 20 years later, are first day VPs, and now they're superstars in their early 40s. And they've worked together for 20 years and they're coming to their best years of performance. The operators we've hired in laterally over the years, and we started with generalists who could just help run businesses. Now we add specialists in getting the accounting systems faster. We did just hire an AI specialist to apply it to apps faster. We have, Salesforce experts. So, the luxury as the firm grows, we've invested back in the firm to build and strengthen the team. Plus, we have something called the Executive Advisory Council, which are 60 other operating partners that we don't even list in the team because they're for the projects that they work on.
Knowing what you know today,
Yeah.
If you could go back to the beginning of when you started New Mountain in 99, what would you have done faster?
I never anticipated New Mountain would be what it is. I thought if I could buy 4 $50 million investments with a couple of people helping me, that would be great. I'd have like 4 companies, and I never, had a paper that said New Mountain would. So it's just this continuous desire to get better, better, better. And there were forks in the road where if we zigged instead of zagged, it was close. We were buying our first company and we had the deal terms worked out, and a strategic came over the top with a better price, and I still convinced him to sell to me. It could have been So some of these things that could go either way on you.
Well, 99 is also an interesting time to start business,
Yeah.
right? I mean, that's like, what was going through your mind?
Well, okay, just for historical context, 99 was the original internet. This was
for
like,
sure. Yeah.
puppets.com was worth $7 billion because you owned the word puppets.com. You had no business behind it. So I had a really great track record at Forstmann Little. Forstmann Little was second biggest, but better returns, wonderful. And I went off to raise a fund. And I said to people, I think I can go for a 30% gross return for you. They go, that's terrible. That's awful. I mean, I can make 1,000% overnight in puppets.com. I'll go, I can't deliver 1,000% overnight. I mean, people were making these wild. So I was just, people had no interest in private equity. Then a year later, puppets.com had collapsed and all of those companies had gone to zero and everyone was in shell shock. And I'm saying, well, I know, but I'm still, our strategy works. And fortunately, what happened with me is the first company we bought control, but we let it continue to trade publicly on the minority. And it went from, it ultimately went from 25 to like 125 as everything else was crashing. So that gave me the momentum to get going. But I went against the hype cycle and then the despair cycle. And I'm just trying to be steady in the middle. And it wasn't that easy.
So current time is a little bit turbulent.
Yeah, day by day. It depends what day we have the interview. So.
Exactly, day by day, exactly. So, and it's also a relatively uncertain economic period. But I imagine, not to compare the two times because there's certainly differences, but 99 was not an easy time to start a firm. 2000, obviously, probably had to look in yourself in the mirror a lot as people were questioning whether or not they could allocate to fund as stock market was going down, et cetera.
Right.
How would you take some of those lessons that you've learned from that, and you went through 08, to today as you think about investing in today's world?
Well, let me go even a little further back. I went through 87. I remember when the Quotron literally stopped working. It just stopped reporting stock prices because I thought the guy had a heart attack and fell on the keyboard or something. So I've been through 87, the 90 junk bond crash, the Russian, the Asian crashes. So there's always going to be bad news around the corner. So the whole idea of New Mountain from the beginning was, look, we're not going to outguess trends. But even within bad times, there's always niches of the economy that starting at this point forward for the next 5 or 10 years have secular growth. Let's focus on those niches. That's the defensive growth. That's like building your house on solid ground. Let's get stronger and stronger at adding skill to businesses and building them. And you can be as non-cyclical as possible. So that's what we never tried to guess when the good news is going to hit or the bad news. We just powered through it. And again, when we raised our fund last year, that was considered the worst fundraising environment of all time. Before yesterday's news, it was even worse last week, and tomorrow may be the greatest time. I mean, who knows? So we just do what we do and try to be as immune to the market conditions as possible.
And now
we're all weather. We try to be an all weather, build a business fund or build whatever we do it the best there is.
And now you have dry powder to invest, which is also helpful. Do you think now's an even better time to be in private markets, given everything that's going on in public markets?
Well, I personally just have no affection at all for public markets. I don't want to be in public markets. Occasionally we take a company public. And I was at a Goldman conference, I said, my happiest day is when you ring the bell. And after that is usually misery because it goes up, it goes down. You go, but the earnings didn't change. I mean, the earnings are up, but no, the market sentiment is wildly swift. So I don't really love public markets, nor do I know how to outguess public markets. But private, to own a company, we look at hundreds and hundreds to buy a few a year. So you can choose just the right industry, just the right company, and then build it. Your fate is in your hands. So it's not risk creates return, it's skill creates return.
I think that's a really interesting point and really instructional for people too, because I think there's a lesson in there. What do you think people who think about public markets can learn from private markets in the way that you'd invest and help operate a company in private markets?
A lot of what they teach in traditional finance, I disagree with, or I think they oversimplify.
Why?
Okay, this is one of my pet peeve ideas. They always talk about risk and return go together. Risk and return go together. If I'm in the boxing ring with Mike Tyson in his prime, I have all the risk and he has all the return. Risk and return do not go together because boxing is a game of skill and he is a really good boxer. And when they say risk and return go together, they're assuming out any ability to actually change the underlying business. They're assuming an efficient market or there's nothing to do. So of course you have to bet more at roulette to make more. But what you want to do is pick up the roulette ball and put it in the slot with your own hand. That's called business building. So what we do is control the risk and make the return by building the business. And it's so frustrating as a public market investor, you can't really do that. You're not the one running the company yourself. You have no special information. If you did, you couldn't buy the stock in the first place. You may have made the right, you could probably give me personally the earnings of every company 5 years in the future, and I still might not be able to beat because the market expected more or the market expected less. I used to know a news announcer on a financial news channel, and I don't think they knew what the headline was going to be. And they always could say after, well, the market was expecting more. No one knew until the stock reacted what the market expected. So I find public markets mystifying. I have spiders and stuff. I think it's an important asset class, but I know what we do. What we do is, to me, a very predictable, a business that you can execute.
On the point of what you can control, I want to talk about price for a second. So how much in your mind does price matter? And I ask that not in the general context, or not just in the general context, but also in the context of as more capital flows into a space, sometimes price increases, but it doesn't mean that it's still not a good business. But getting in at the right price can matter. So how do you think about that element of investing?
Well, we're growth at a value price buyer. We don't just pay up, high prices because it's a good industry. That being said, I don't think the key is if you buy a company for 100 and you have a plan to get it to 300 of value, if you end up paying 105, that doesn't ultimately affect. What really matters is you can get it to 300 of value. If you're just passively sitting and paying a super high price, assuming that super high price is going to continue forever into the future, that there'll never be multiple degradation, I think that's a very bad strategy. So the key, the more and more you can be fundamentally changing and re-rating the business. Like we've had service businesses that we bought as services business. By the time we exit their software business, we turn them into SaaS, from service to SaaS under our ownership. So it's what you can do with the business. And then we try very hard to get a good price. We've been buying under the comparable prices because what we can do is find the seller who says, look, I want to work with New Mountain because I'm going to keep some stock in the company and I'm going to, we'll build the value of the business together under your ownership, New Mountain. So we have these two bite at the apple arguments that I don't think we overpay it. We try not to overpay as we buy. We're very careful.
So you're judicious about price that you pay, but thinking about private markets going forward, what are you most worried about?
To me, the ultimate fate of New Mountain is how well we can build our team, the skills we can add. You need, it's easier in a good world than a bad world. So, we lived through COVID. I don't want another plague to hit. I don't want war to break out. So you try to have as much background stability as possible. I do watch the Washington situation. I think our reputation is worse than it should be. There's kind of just populist anger against private equity that I keep trying to fight against by giving examples and by doing our social dashboard and all that.
On that point, do you think that will make you look outward more and invest in other regions of the world more?
We work really, really closely with our management teams. So the companies we buy are almost all headquartered in the US where we can deal with them. So a few have been in London, but we can still deal with them. That being said, you can take the mid-market businesses and expand them internationally. We're very aware it's a very large world, and we're very good at taking the businesses globally, doing things the most efficiently we can around the world. But we don't have a Singapore team buying a company in Singapore and a Australian team buying something in Australia. We're one unified team and working together in New York.
So I like to ask this question to everybody to end because I think there's so many different perspectives and views. I think we're in such an interesting time right now. Rather than look backward and say, what's your favorite or most interesting investment in private markets? Going forward, what are you most interested in or excited about from an investment perspective in private markets?
In private equity, we have 12 sectors identified with 25 subsectors. We're having tremendous success there's so many errors in the healthcare system and so much inefficiency. To add technology, and I don't want to overplay AI, but just add technology to do next-gen systems to make healthcare more efficient has been a major area for us. We're building out the power grid. We're building out the water grid. We're the technicians within the data centers. I mean, so infrastructure has been a wonderful area for us. We're doing accounting firms has been a great area, other financial services. So we have a whole bunch of great areas, and we're always looking for the next one. But what I'm really excited about is, can we make New Mountain better and better at understanding and building businesses? So that applies to our credit arm, our net lease arm, everything we do. So I'm just trying to build the institution. We are a business that builds businesses, and I'm trying to build a business that builds businesses.
What's the next step of building the business, of building business?
Of New Mountain, we are very, very focused on the wealth channel. We think we have a really great position to be a product that's not just, oh, everyone's seen this product. Here's the special product that's a little unique and a little fresh. So we want to do that. We do very much believe that, you mentioned this early, secondaries in private equity are here to stay. We've done continuation vehicles of our own companies, which I think have been some of the most sophisticated uses. We do want to have the ability to buy into other people's continuation vehicles because we have the analytical power, and we can add value to their business even if they keep their GP stake. We can still increase the earnings with them, bring them customer relationships. And so we can be value added in that area. So those are two of the key places we're growing.
I think that's so fascinating and such an interesting way to end, because we started with talking about how there's a $400 million private equity firm, KKR, in the industry. Forstmann Little was the second largest and at a fraction of the size.
Yep.
And now we're talking about $55 billion firm. You're thinking about, you're beyond just private equity, credit, net lease. You're thinking about secondary CVs. So I think it's just emblematic of the industry's evolution, and you've been right in the middle of all of it.
Yeah, thank you very much. Yeah, I mean, a good firm should be a lasting institution, and I think firms are moving in that direction.
Well, you're also a business that's building other businesses. So thanks so much, Steve, for coming on the show.
Thank you so much for having me.
Pleasure to have you on. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're